Hi traders, on today's video I will be showing us the 5 most effective trade strategies as has been recounted in my trade experience. These strategies are features, functions, the basics of what trade entries. We most times tend to downplay their relevance, but I was able to make this video with much emphasis on how we can be able to use these strategies, and it cuts across the financial markets from crypto trade, forex trade, and the rest of them. So, with this strategy, adapting them, trying to follow their precepts, will enable us make proficient trades by having what good entries and what good exits. The essence of whatever we do in the financial market is to what maximize our profits. Let's have more profit. The more we profit in this market, the more our confidence boosts. So I'll be moving over to the first point, which is what leverage control. Avoid high leverages. No matter how tempting the profits could be, the farther away your liquidation, the more logical your stop loss. Let me just take an example on the Bitcoin price charts as an instance. Now let me look at here. Let me look at here. Let's assume that there was a spot in the market who spotted something that the market will go up. Probably it was spotted somewhere around this what range. When the market dipped, there was a range, right? And this range signals that there could be a trend what reversal. Let's assume that it was well analyzed and spotted that the market will go up after this what dump here. Now let's say you made an entry at 16,200 levels, which is where I'm pointing at. Someone made an entry. If your leverage is high, the market tanked lower to what 15,900 thereabout. If your leverage is high and your liquidation is around 1600 or 16,100, now you made an entry around what 16,200 levels. Now you can see that the markets have already what blown your stop loss, assuming you are longing. Now after blowing your what stop loss, probably your liquidation as well. Now markets will start what range again, and look at, we'll find the market at 16,500. You made an entry at what 16,200. Market is at 16,500. The next, another range, and we'll find the market at almost what 17,100. Now, if you are trading with a high leverage, you cannot profit in this market. But assuming you traded with what controlled and lower leverage, your liquidation might be around 15,800 thereabout, where you can have, or probably 700, where you can have your stop loss around 15,800. Now if we check the previous area of support, what support around what 15 what 15,600. So you should be considering your stop loss to be at what previous area of support, below previous area of support. You shouldn't be hovering around what your area of entry. So your liquidation hovering around your area of entry is not what a good trade setup. So with this kind of high leverage, you get blown out of the market, and your targeted profit will still be what met in the market. So that's the reason to what avoid what high leverages. The farther away your liquidation, the more logical your stop loss. It's more reasonable to chase $100 with 90% chances of getting it with just 10% risk exposure than chasing $1,000 with what 10% chances of getting it, leaving you with 90% chances of losing out. So in most times, the higher the leverage, the higher the profit. But why not chase little profits and be sure of it than chasing what high leverage and lose your what trading capital? So I encourage us to try to put a reasonable control over our what leverages. The second one we have is what don't FOMO. FOMO, we already know the meaning. Most of us should know, unless they are the newbies. Means what? Fear of missing out. You don't have to fear of missing out a trade that has already pumped or dumped. Most of the time, we find ourselves jumping into a trade because we see the market already pumping, or jump into a short position trade when we see the market already dumping. There should be a prior analysis to that trend before you enter, and you should enter early enough so that process of already pumped market, you're already taking your profit, and market has pumped, you are already in profit, taking your profit, or already dumping, you are already in profit. It won't be when market has pumped, you are not entering. You might be entering at the what at the top, and the next will be following with what will be another dump. So like we know, market is full of pump and dump. That's what the financial market does, pump and dump. Don't jump into a trade because you saw the market already pumped or dumped. Be sure to make entries at confirmed key levels such as support and resistance, breakouts, or bounces. Be sure it's on area, verified area of value of buy low or sell high, so as not to be caught in a bad place. Whatever we do in the financial market is to what? Buy low, sell high. That's how we can be able to what? Take profits, whichever comes first. You can even sell high and buy low, sell high and what? Buy low, or buy low, you sell high. That's just the what? The summary of the whole thing. So FOMO will make you what? Mix out a good entry. I most times don't encourage traders to enter market that has pumped up to 10% thereabout, depending on the coin pair. So you ought to what? See the pump coming, make your analysis straight, see the pump coming, you enter on time, take profits right on time. The longer you stay in the market, the likely you are to meet reversals in the market, because one mass market has already pumped and you enter, there could be a range that could what? Reverse the trend, and you will be in losses. Always follow the trend. Be sure your trade entry is in line with the market trend. Short positions mostly for downtrends, while long positions for uptrends. And sometimes we might want to scalp, that is going against the trend quickly for what? A quick profit. If you scalp going against the trend for a quick trade during pullbacks or and retracements, if necessary, should be done what? Swiftly, to avoid being caught up with reversals. Sometimes, assuming in an uptrend we are longing and there is a pullback, logically we anticipate a bounce at the previous support before trend continuation. But in a healthy market, it might not get to that what? Previous supports, and there is what? A trend continuation. Someone that is scalping, that is shorting in a what? In an uptrend, expecting what? A bounce at the support level, there might be a what? Reversal, and that trend continuation instead. And that trend continuation, where you'll be finding price again, you'll be in excess losses that you might not even see your entry level again to even go with your capital. So it's very, very risky to scalp. But if you must scalp, do it professionally, do it swiftly, but at a more sensible what? Entry. Make short positions for what? Downtrend, long position for what? Uptrend. Follow the trend, flow with the current, and you what? Be safe in what? In the market. The fourth one we have is be consistent with drawings. Always take your time to make the necessary analytical drawings, such as trend lines, trend channels, support and resistance lines. Drawing will enable you to understand the market structure. Watch how markets react on the levels you've drawn out, and figure out your entry and exit levels with ease. Drawings are necessary. It's through drawing that you can have a pictorial representation of what market is forming, what price action is doing. You can actually know, okay, this is a very consistent area where market has touched several times, and you see how did market react at this level. You understand the key levels, areas of value, and once market is reacting in a particular level, you will check the volume and other confluences that will determine whether market will dump from that level or pump from that level. So be consistent with drawings is very necessary. It will just give you a pictorial representation of what? The market structure. Good entry eliminates greed. Most of the time we tell ourselves, don't be greedy, don't be greedy, don't be greedy. Enter right, you see profits doesn't take too long to roll in. Waiting for too long for profit in most cases could be a wait that would result in trend reversal. Most of the time, if you find yourself in a market whereby you enter the market, you're already in red, your profits are in red for long, you are struggling, waiting for market to bounce, to the your targeted area of profit for you to be in green and make profits. You wait for too long. Probably most of those waits are waits in what? That will result in reversals. At the end of the trading section, you are in losses. You could wait for too long because you didn't make a good entry. Now, before we come down to this making good entry, if you have actually adapted the first steps, 4 steps that we talked about prior to this what? Fifth or last step, there is no essence. Being able to get it right from the initial steps will actually help you make good entries and automatically eliminate greed. Being greedy is more like waiting for profits at some price levels that the market might not attain within a particular trade period before reversals. Pullbacks or retracements could happen at the long run. So I urge us to try to adapt this method, the 5 of them. There could be more, but we could be able to actually follow these 5 steps keenly. Now, talking about good entry eliminates greed. Most of the time, we tell ourselves, don't be greedy, don't be greedy. Some things might cause us to be greedy, and sometimes I don't even see them as greed. I see them as mistakes we make in our entries, and it will look like we are greedy. Enter right. Once you enter market right, you see that profit doesn't take too long to come in. Sometimes when we are waiting for profits, most cases we end up in reversals. Once we are waiting for profit for even long time, if you make a good entry, you'll be just right on time. Your profit will be right on time. Being greedy for me is more like waiting for profits at some levels that the market might not reach, price level that market might not reach at a particular market what or trading period. So at waiting for those levels, for instance, the market would likely, let me assume Bitcoin opened a trade at 17K levels, and there's tendency that it will hit 17.5 within that trading period, within that daily time frame or particular time frame that you would engage in trading. And at some point, someone probably entered at 17,400. A market will likely reverse at 17,500 or 17,600. Someone entered at 17,400 and waiting for what? Probably 17,800 or 18K. At the end of the day, market closes below 17,400. The person would end up waiting for what? Price to reach levels that they couldn't reach within that trade period, and it looked like they were being greedy. Maybe market touched 17,500 and closes at 17,300. They entered at 17,400. Had they made their entry right, they wouldn't be caught up with that kind of what situation. So you make good entries. And how would you ensure you made a good entry? By adapting the 4 steps that we earlier mentioned before the fifth one. If you're able to get the 4 prior steps right, there are greater chances that you'll be able to make good entries. Automatically greed will go away, because once you see profit on time, you see enough profit on time, you automatically leave the market without being greedy. So I hope that we'll be able to adapt these 5 steps in our trade entries. Thank you very much for watching my video. Subscribe to the channel, hit the like button, comment and make suggestions and recommendations for any video of interest or any topic of interest that we'll be considering in our next videos. Thank you very much. See you next time.